The commentary that follows is addressing a closed-end fund. This type of investment program has many limitations on liquidity, and investors should not expect to be able to redeem share on demand or in the quantity desired. Given the complexity of this investment, reading and understanding the prospectus is very important. Please see the disclosures and prospectus link in the description of this episode.
Welcome to Educational Alpha. I'm Bill Kelly, CEO of Chi Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, Bill welcomes Steve McCourt from Meketa Investment Group to discuss the significant shifts within the investment landscape. Steve shares his journey from joining a small consulting firm to becoming a co-CEO alongside the evolution of Meketa. He provides an in-depth analysis of private markets, emphasizing the importance of private equity and infrastructure investments. Steve delves into the challenges and developments within the consultant model, reflecting on his experiences and the industry's future trajectory. Listen in.
Steve McCourt, welcome to Educational Alpha.
Great to be here. Thanks, Bill.
I assume you're in the great state of Colorado, which I last saw you maybe around COVID-ish time, a few years ago, I think.
I am not. I'm in the great state of California, San Diego area, Carlsbad, California.
Better weather trade, beautiful spot there.
Yeah, beautiful spot, but travel all over, often in Colorado.
All right, good. I think true to form on this platform, I do ask the guests to provide a little bit of a background so the listeners can have a sort of an understanding of the perspective from where you come. And I was mentioning to you right before we hit the record button that you're that rare guest that I think may have spent your entire career with Meketa. Maybe you could talk a little bit about from whence you came. And I think it's going to be a short part of the discussion, but maybe a bit on your background.
You are correct. I joined Meketa in 1994 when Meketa was a sleepy 8-person investment consulting firm with about a dozen clients and have spent my whole career there since. At that time, of course, I was based in the Boston area where our headquarters is. I worked there for 8 years and then moved out to San Diego in 2003 to open up our West Coast office. It was supposed to be a short adventure out here, but it's turned into 22 years. No one can extract me from Carlsbad, California today. It's been a great ride along the way. The industry's evolved a lot over those 30 years. Meketa Investment Group has evolved a lot over those 30 years. When I look back on it, while I've had the same employer for 30 years, it doesn't feel like the same company. Very different industry we operate in, very different company in terms of our size and scale and capabilities as well. And so it's been really fun and continues to be really fun to this day.
Great. And I want to talk about the evolution of the consultant model. And I know Meketa well, and I always thought highly of it on the asset management side. But I think it might be interesting to take a quick pause and talk about the evolution of your career, because I think you said 1994. I doubt they hired you in as co-CEO. So the pathway up toward the C-suite, and that doesn't have to in and of itself define success. There are many ways of achieving success in any organization, in any career. But again, nothing's a straight line either. So maybe talk a little bit about the progression, where you started inside of Meketa and then how you navigated your way into the seat you're in today.
Not only did I not start as co-CEO, I had no idea what the investment consulting industry was. I didn't know what pension plans were. It was all brand new to me. And thinking back on what attracted me to Meketa and the job was really the ability to learn about how financial markets operated and worked at a practical level. One of the great things about being an investment consultant for institutional clients is you really see firsthand how capital is allocated across the economy. And coming out of undergrad, I was very much focused on economics, wanted to be a PhD in economics down the road. And so it was really attractive to me to see firsthand how these larger institutions made decisions around investing their capital and the various challenges that they faced. I perceived it as a great learning opportunity, and it exceeded my expectations in that regard. I felt from the time I was in my early 20s an ability to get a handle on a extraordinarily complex and global marketplace very quickly. And the other aspect of it, which I really latched onto, apart from the technical financial side of it, is consulting at its core, like a lot of industries are at their core, is a relationship business. And it's about the people. It was just a great way to marry interest in technology and technical skills around investing, all the CFA stuff, and practical real world experience in working with people who are actually making the critical decisions on investment strategy. So all of that really attracted me, and it continues to inspire me today. It's what I love about our industry and how we operate within it. So I worked in our Boston office, joined at a propitious time. We had been around for about 15 years before I joined, but really started our growth as I joined and shortly thereafterwards, as much of the world started to notice Meketa in the late 90s into the early 2000s. And I think what we were able to do successfully as an organization was really anticipate where the future of asset allocation and pension and endowment management was heading, number one. And number two, have the interest and ability to reinvest capital back in the business to develop the needed resources to meet the future demand of the marketplace. And our founder, Jim Meketa, was extraordinarily helpful in both of those endeavors. It's interesting looking back on it, and you'll remember this, Bill, the late 90s, we had 5 straight years where the S&P was up over 25% or so, some years much more than that. And as an investment consultant, the biggest issue we faced wasn't funded status or the health of pension plans. People were trying to find ways to spend their surplus in their pension plans. It was really about how to diversify client assets away from the major asset class in which U.S. pensions were invested, U.S. equities that appeared significantly overvalued by any reasonable basis. And so as we looked at the marketplaces, we conducted our own research on private equity as an asset class. And after that, began advocating that our clients commit capital to private equity as an alternative to public equity that may not be as highly priced as public equities were at the time. And that was very different than a lot of our peers at the time and required significantly different and greater skill sets in terms of guiding our clients through the private markets. We also were very thoughtful in helping our clients diversify outside the U.S. equity markets into global markets, which today is fairly standard, but back then, as you'll remember, was less common. During this time period in the late 90s to the early 2000s, we created the private equity organization within Meketa as it exists today and began growing and building that. And private equity as an asset class sort of evolved into several other private market asset classes like private credit and infrastructure. And we built resources around that and advocated for those allocations within our institutional client portfolios. And all of this seems very prescient in retrospect. I can assure you that each and every one of those received a significant amount of resistance from the marketplace. Private equity is too expensive, is too opaque, blah, 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 blah. Infrastructure is too low returning. It's not appropriate for clients that need 8% returns. In a funny way, like I've spent much of my career defending the private market asset classes. And at some magical point in time, 3 or 4 years ago, the world just shifted. And all of a sudden, most institutions acknowledged after so many decades of strong outcomes from the private markets that private markets were not just a relevant asset class or series of asset classes for large institutional investors, but rather necessary for successful portfolio management. And one stream of my career was helping develop the private equity and private market platform at Meketa and advocating that across the industry and the marketplace largely. I've also been involved in opening up various offices for Meketa, expanding our scope geographically. Most fun for me was opening up an office in London sometime around 2014, 2015 to expand our research efforts over to Europe. I initiated and executed a merger with one of our friendly peers in the marketplace, Pension Consulting Alliance, in 2019. And throughout all this, built out our West Coast business with institutional clients based in the western parts of the US quite successfully. I feel like the journey to co-CEO has been multifaceted, fun every step along the way, and continues to evolve as we move forward from today. I should note, just finishing up on your question, I became co-CEO with my partner, Peter Woolley, in 2015. So it's been almost 9 years now. And that was an important juncture for Meketa Investment Group as an organization, because prior to that, our founder, Jim Meketa, owned the majority of the organization. And that allowed us to really transition ownership and management to the next generation at Meketa. And that was something that continues to hold back a number of our peers, but really helped advance Meketa, expand our ownership base to over 70 shareholders today in the organization, and continues to have a lot of positive momentum behind it.
It sounds like a very thoughtful answer, clearly. And I think anybody that doesn't begin an answer with "it's complicated" probably is either damn lucky or just plain lying. So I appreciate the background on that. And maybe segueing a little bit from the old consultant model to the new. You joined at an interesting time. It was just when we were launching Boston Partners. And not only was the S&P compounding at a very attractive rate, the Russell 1000 Value equity managers was an awesome time. And then something called the tech bubble brought everything down to earth. And then the GFC hits and the taper tantrum and the COVID drawdown. And these big seismic events in the capital markets cause all of us to take a step back and say, what did I learn from that? And I don't want to have to experience that a second time. And we don't have to control and can't control the markets, but we have concentration of risk in our business model. And you come out the other side and say, what did I learn? But then some things happen much more gradually, and we don't really notice them creeping up on us until they're right in our kitchen. And that is, I don't know, it was the Tax Act of 1978, where an actuary by accident created the 401k plan. And that was really the beginning of the end of these large pools of money in the DB space. And they're not going away, but they are in secular decline. And certainly in corporate America, they're more or less done. You can't get one anymore. And the public pension plan space, a little bit of an exception. But now we have the individual investor is the dominant asset owner based on most of what I see. They're about, by most estimates, 150 trillion, and the institutional investor is just shy of about 140. So that dynamic is going to continue to move in favor of the individual investor. So it's not so much that's where the action is, but we've got to have a business model that can address their needs as well. And they are going to be very different than the sophisticated institutional investor, and how we give them access. I think we must is the short answer, because if you and I are responsible for our own retirement and capital formation is happening in the private markets, banks are not lending anymore. So the true home of the bond market is now in the private markets as well. We've got to find ways of playing in that space, but how do we do it? And what vehicle do we wrap it in? I think these are all very interesting questions. It's going to take us a while to solve for them, but I think there are some pioneers. So I'd be interested from Meketa's standpoint, are pension consultancies, and Meketa specifically, are they still in the garden variety search business? If they are, it's probably become a much smaller business. And then what was the catalyst for Meketa to say, hey, I've got to wake up and focus on a very different world going forward, which is catering to a very different type of investor with different offerings, different risk tolerance, different calls on liquidity, et cetera?
Let me first start off by saying that the federal government's lack of support for the defined benefit plan model over the years is, in my mind, a huge public policy blunder. I don't think it's going to change, but defined benefit plans have tremendous benefits, not just for beneficiaries and sponsors, but for the economy at large, and are generally very efficient ways to fund societal retirement. I agree with you, but only regrettably so, because I think we are continuing down the road of 401ks and individual retirements, and those merit significant attention for investment solutions. Meketa, to answer your question on what spurred our interest in that marketplace, we've known obviously about the individual investor marketplace for forever. I guess we're individuals too. But for the last 30 years, we've been busy growing and expanding within the institutional channel. And that's just consumed all of our thought and resources. But what's important about that from a business perspective is our corporate mission and values isn't to grow the number of clients that we have or to grow revenue and other economic metrics of an organization. It's really to do our best to improve the investment outcomes for our clients who are predominantly defined benefit plan institutions and endowments and foundations, so they can help their beneficiaries achieve the strongest retirement or spending outcomes as they can. And by and large, their beneficiaries are blue-collar America, middle-class America. And that's what's driven our company and our brand for 45 years. We focused initially, and still a big part of our business is working with Taft-Hartley union pension plans. And we feel proud to be able to bring the strongest investment advice to institutions who support middle America. When we looked at this marketplace, we were introduced to it first by my now partner, Michael Bell, who started a company called Primark about 3 or 4 years ago in Denver to help democratize private equity. And Primark created an interval fund, which is now called the Primark Meketa Private Equity Investments Fund, to provide an accessible way for RIAs to allocate to institutional quality private equity across their client base. And so it's a 40-act fund, daily priced, daily NAV, no K1s, 1099 tax treatment, and no accreditation for investors. All types of investors can invest in it. So it's an easy way for RIAs who service lots of clients, not just the super wealthy, to participate in private equity, which is an asset class that historically has been focused on the super wealthy. Being able to be a part of that trend of democratizing private equity meant a lot to us as an organization. And so Michael, when he reached out to us to ask us to sub-advise that vehicle 2 years ago, it was very much aligning with what Meketa's brand has always represented in the institutional marketplace. When we began sub-advising the vehicle and began meeting with the RIA firms that Primark distributes its vehicle to, it became very clear that there was interest in that marketplace for other products and services that Meketa could contemplate based on its infrastructure and resources today. After about a year of planning and coordinating, we created a subsidiary to Meketa Investment Group called Meketa Capital to focus on the financial intermediary and RIA marketplace. And we did it as a separate subsidiary for a handful of reasons related to both wanting to create an entity that was specialized and focused on the needs of that marketplace, and also not to distract the broader Meketa Investment Group organization from its traditional focus in institutional clients. So Michael Bell from Primark joined us as a CEO of Meketa Capital. We brought in another partner who was a client of Meketa's, a gentleman named Chuck Widger, who founded and ran and sold a business called Brinker Capital in that industry to provide us growth capital and is an equity investor in the business as well. So Meketa Capital will now represent the entity through which any and all Meketa services and products are offered to the RIA marketplace in the future, which is a great way for Meketa to expand its ability to impact, at the end of the day, middle-class Americans and supporting as strong a retirement outcome as they can possibly get.
And then in terms of the structure, Steve, am I right in assuming that you're making direct investments in portfolio companies? This isn't a fund of private equity GPs, right? It's direct investments?
That's right. These are the Primark Meketa Private Equity Fund and the newest vehicle, the Meketa Infrastructure Fund, are both interval funds that their core investment holding are co-investments, no fee, no carry co-investments.
So who does the due diligence? And maybe talk a little bit about that process for every investment that you make. Is there a target market or a target sector or a target geography? And then maybe what doesn't make the cut in terms of a business model? And you obviously have got to be thinking about your ability to help grow these businesses too.
Following on the theme of Meketa bringing the best of what we've learned from working in the institutional marketplace for the last 45 years to individual investors, both of these vehicles capitalize on our identification and support of who we feel are the strongest general partners in the private equity and infrastructure marketplaces, respectively. So focusing on private equity first, Meketa Investment Group has been investing in private equity funds on behalf of our clients for more than 20 years. And we've taken the strongest funds that we have the highest conviction on and have notified all of them that Meketa now has interest in any co-investment opportunities that they have across their vehicles that we invest in. And so we get significant flow of co-investment opportunities that come to us through that population of private equity general partners. We take that flow of co-investments and through a process of due diligence and also focusing on creating as diversified a portfolio of co-investments as we can, identify co-investments over time to add to these portfolios. And we typically add at the size the private equity fund is right now and its growth rate currently, we're adding about one co-investment per month. And that's out of a funnel of maybe 10 to 15 co-investments that we have access to every month through our general partner network. Infrastructure will work the same way. Fewer number of GPs, but significant co-investment flow that comes to us. And then we evaluate the co-investments to identify what we feel are the strongest in terms of their alignment with the general partner's core competency and selecting them based on diversification goals and objectives related to the portfolio.
And then do you get directly involved in these individual businesses as a co-investor, taking board seats, involved in strategy, or do you leave that up to your co-investor GP?
Nope, we're passive investors. All of the board positions are handled by the general partners who we partner with.
Okay. And then if you think about, and I want to spend a few minutes on the wrappers. So these investments on any given Monday or quarter, as an example, are not providing any liquidity, yet the fund, I assume, provides some frequency. I assume it's maybe a typical interval fund of 5 a quarter, 20 a year, if that's the right structure. So where does that liquidity come from?
RIAs can invest client capital in every day. If they want to take capital out quarterly, there's a process. About 20% of the fund's NAV and a combination of cash and public securities to support the liquidity needs. And then the other 80%, 70 to 80% is in private market assets. And we monitor that regularly. The various sources of cash include any new inflows into the fund during the quarter, any liquidations from the co-investment portfolios during the quarter, and then the uses of capital are the quarterly flows. We have models that model out the timing of all of that, and we maintain a fairly cautious positioning on the liquid component of the overall portfolio.
Maybe sticking this for the moment, it does interest me, and I don't know if we've explored this directly, Steve, with other guests. Everything works well when you're in net subscription mode because there's always cash coming in, maybe less so on the other side, but I'll park that for a second. So you talked about investing in public equity securities. Do you try to mimic what a private equity return might look like, i.e., are you looking at common industries, maybe in the micro to small cap space? Maybe the fund is not big enough to take on positions that you can trade it in and out of with some frequency. But what is the thought about the public equity exposure? Are you trying to mimic the private exposure to the extent you can get some correlation to it?
We looked into that, Bill. There's a lot of ways to think about mimicking the private equity return stream with public equities. Our conclusion is that none of the solutions work particularly well. What we end up doing is we took a fairly common index and we overlaid that with an institutional factor model that Meketa has used for over a decade. which we call QSI, quality, stability, and income. Within any universe, it weights stocks that are of somewhat higher quality, somewhat stronger stability, and somewhat higher income dividends relative to the broader universe. And one of the screens we use in doing that is liquidity in these securities, because ultimately 90% plus of the investment outcome of the interval fund, we want to be based on the co-investments in the portfolio. So the primary focus of the public securities is liquidity. It's great if that liquidity can look a little bit like private equity, and so we choose public equity companies. They tend to be larger, often publicly traded private equity firms, and invest in 12 to 15 of those in a diversified portfolio. That gives us a lot of confidence if we need to liquidate, even when the fund's a couple of $1 billion in size, to satisfy any capital calls.
Okay. I'll concede, I think the interval fund might be the very best wrapper that we have. Whether or not it is the killer app, I'm less sure about, and you can comment on that in a second. But maybe leading into that, in maybe the Meketa business model of yesteryear and you in a different role, if I'm David Swenson and you're knocking on my door and explaining to me this co-invest fund you're bringing forward, and I say it sounds good, put me down for $20 million. And that goes into a fund and it's a drawdown commitment. You call the capital. And then after the 7 or 10 years, when everything's done, I say, how did we do? And you talk about my IRR and my MOIC and whatever else is in place. It has to be that way because you're responsible as the GP in managing cash flows, and IRR is the best measurement tool. I don't know if many investors really understand IRR versus a time-weighted return. I think we have to, as an industry, and maybe Kaya's responsibility, do a better job judging that. But then we take a vehicle like a drawdown fund that is meant to have money in the ground as quickly as possible, staying in the ground. But then what does the average individual investor want? Kind of liquidity on demand. And we say, we really can't do that in a 40-act fund. Here's an interval fund. But if you went to a David Swenson and you told him that he and his co-investors could come in and out, that sort of flies in the face of who I want my co-investors to be. Because if I bought into the strategy, I would love you to have no liquidity. But the SEC and others maybe get a little bit upset with you if you go down that path. So what is your view on the interval fund? And it has its shortcomings. And then I am curious about, and this is obviously a lot of moving parts to this question, I am curious if I'm an investor in this interval fund, how is my performance being measured? Is it a time-weighted return? Is it an IRR? Is it a modified IRR? So I can repeat aspects of that or break it down. So it's sorry to throw a pile of stuff at you, but there we are.
So hitting the interval fund piece first, and I'm far from an expert on all the various types of vehicles that have been tried on the retail marketplace over time. And I would agree that there'll be more product innovation in the future as well. First thing I would say is a lot of, in any asset class, an investor's perception of success or failure in an asset class is often based on whatever context is placed there for the investor when they invest. And so for us, one of the things that gave us a lot of comfort in approaching the interval funds in the way that we are is that we are only offering these through RIAs. So in a sense, the RIAs are serving a role for the retail marketplace that Meketa serves in the institutional marketplace. They're advising clients. They're educating clients on private equity and illiquidity and time-weighted rates of returns and IRRs. We can help the RIAs in that educational process, but it's important for us to know that a professional financial advisor is there telling clients, you're investing in this not because of the limited liquidity feature. Yes, if you have to pull the parachute, there's a liquidity feature there, but that's not smart investing. Smart investing is investing in a private equity vehicle and watching it evolve and grow over 10, 15, 20 years. So we've not gone direct to consumer. We've not pushed other channels in this, partly because of that consideration, Bill. For us, it's important to know your client, and we want to know that the end clients in these vehicles are being properly educated about the reasons why to enter or exit private equity. And at the end of the day, this is an illiquid asset class. That's also a long-term asset class, and investors in it, regardless of vehicle structure, should acknowledge that. The time-weighted versus internal rate of return is interesting. It confuses all my institutional clients, so I don't have a lot of hope that individual clients will grasp it any better. The interval funds are typically measured on a time-weighted rate of return basis because they're daily priced. And there's some argument in the interval fund area that time-weighted, if it's not better than IRR, at least there's more relevance to it. The major difference in rationale of using IRR versus time-weighted rate of return is that in a private equity fund, the manager has control over when capital is called and deployed. If the agent who you've given your decision to call your capital has the ability to time when that capital is called, then it's appropriate to judge that manager based on the time of that call, and you do that through the internal rate of return. Time-weighted rates of return were really created for the mutual fund industry so that we can compare the 4,000 mutual funds that are out there on an equal basis, regardless of whether I'm moving money in or out on a given day, because I get to choose when my money goes into a fund, and I get to choose when my money goes out of the fund. The mutual fund manager does not. So interval funds are a little bit of a tweener because capital flows into our fund every day. And in that sense, it's more like a mutual fund. I'm not determining as the manager of that fund when the capital comes to me. But once that capital does come into the fund, we have a timing decision on when it's deployed into co-investments versus remaining in cash and public securities. And every quarter, that capital can be called from us. We have to maintain some amount in cash each quarter as well. These types of products, the precise calculation would probably still be an IRR, but I think they're closer to a time-weighted philosophy than traditional private equity funds are. But what I'll say, the great advantage over this interval funds or styles of interval funds like this and traditional fund vehicles is really the fee structure. So in a co-investment vehicle, the investor pays no underlying fee on the co-investments. And in our case, the private equity interval fund has a 1.5% management fee and a 50 basis point cap on expenses. The fund fees are 2%, and there's no carried interest. The assets going into the funds have no ancillary fees or carried interest going into them. So you're essentially getting access to institutional quality private equity assets at an all-in fee of 2% per year. If you're an institutional investor investing in funds, paying 2 and 20 on all those funds to get access to underlying deals, your overall fee load, depending on the study that you look at, maybe 5, 6, 7, 8% per year. So these interval funds, if you're able to create them using co-investments, represent a much more efficient way to get access to private equity assets.
Which at the end of the day is alpha. So I think that is a very important point in structure that you underscored. So it makes great sense. So we're coming maybe near the end of time, Steve. So I just want to finish with what you're seeing on the horizon. And Meketa's been very adept, and certainly more recently in the last decade under your leadership, about not trying to be on the bleeding edge. And I absolutely respect your approach about knowing your client. I think if you get nothing else, that is so critically important. But as you look about these next 5, 10 years, and maybe you don't have to even go out that far, generative AI, natural language processing, what's happened with NVIDIA's stock and chips and everything else. I don't know what this means vis-a-vis a co-investment thesis that you think about, how it might change the search part of your business going forward. We talked about, is there a better wrapper? And I think there are some GPs out there that have used distributed ledger technology as a feeder fund off the Cayman-based corpus. What interests you, and what do you think about in terms of trying to future-proof the Meketa model?
I think one of the more interesting parts of the way the world is evolving right now related to all this is the inability of the public markets to adapt to what's now become the clear reality of private companies not seeing a need for public capital. That's an amazing thing. For generations, the public market was propped up by regulatory bodies and by the government as a fantastic engine of capital supply, risk capital to the economy. And in the last couple of decades, obviously that's turned into reverse. The regulations on public companies have gotten higher, the costs have gotten higher. Investors have found this avenue of private equity as another way to get access to private companies. And private companies now, with the access to the private capital directly, are saying, I don't know if I need to go public anymore. That's not the best way to run a business looking at quarter to quarter earnings. So I don't know where that is all going to end, Bill, but it seems to me that we're probably going to continue to see momentum towards private companies accessing capital through private channels, and those private channels becoming more and more sophisticated. We're, of course, now seeing it not just in private equity, but in private credit, which is filling the gaps of where the banks are exiting in the financial part of the balance sheet for companies in America. This is all happening in Europe, too. I think there's going to be continued, maybe you call it re-intermediation of the public market companies, additional channels of private investment. And I think you're going to see novel structures and novel approaches, not just for retail investors, but even on the institutional side. The 2 and 20 model has been around for a long time. The 10-year lifetime for a fund, the 3-year investment period, all of that, those are all artifacts from the 80s when this industry was created. And I think as people start moving forward and the volume of capital continues to grow that's going into the private capital markets, all of those terms of engagement between managers and investors are subject to change. And so it's exciting to be in the middle of it right now, and I expect more of that in the future. I frankly don't see, and it's unfortunate, I don't see a change in the trend in defined benefit versus defined contribution retirement savings. So I think that's also going to make novel investment structures more necessary in the economy. I don't see a change in active versus passive investing in the public markets. I don't see investors looking to pay up for active management going forward. That's still going to be a really big challenge. I think the stock markets are, as they get arguably a bit narrower, they're challenged by definitional issues. Even though it's a stock market of 2,000 or more stocks now, if it's only 10 stocks that are driving the market, how diversified is it really? And we lived through that. We talked about that in the 90s. And this is different than the 90s, but some of the elements smell the same. And I guess to create a circle in our conversation, all of that stuff is what makes this job so fun. There's so many dynamic things happening all at once in the industry, in the economy, and as a leader in the evolving investment consulting area, we get to see all of it happen and we get to be a part of it. It's really enthralling.
I agree with all that. We're certainly living in interesting times. And I think what makes this such an interesting industry and business is it is very dynamic and it changes every single day. We're long-term investors, but I absolutely agree. You made the observation here and earlier on DB to DC. We certainly did not get that right. The science experiment is still not really fully understood yet. I was born in 1960. I'm the tail end of the baby boomers. And I even spent, I think, my first 5 or 6 years with Mellon Bank before BNY. I vested in a defined benefit. Now, it's not even going to fill up my gas tank by the time I retired, but I still was able to get a tiny little couple of breadcrumbs. But then as this baby boomer generation retires, we're certainly going to have a massive transfer of wealth. But then the next generations are going to come up self-funded, self-invested, self-directed, self-everything. I just can't imagine it's going to end well. I just hope it doesn't end as badly as I could perhaps see it happening. And then we've got, as I said, the role of sovereigns and then regulation as well. And there's obviously some challenges going on with the SEC's private advisor rules, which is no longer a cottage industry. It's not the David Swenson asset class. This is a big, complicated space. And Meketa is very thoughtful, but some of your competitors may be less so, where let's bring them into the deep end of the pool and see what happens. We've got to be very careful, very thoughtful. But I agree with the premise, and not so much from you, but in general, that if you and I have responsibility for our own retirement, we've got to have access to where capital formation is happening. It's in the private markets. Dodd-Frank got the banks out of the lending business. How we cross that Rubicon in a safe way, I'm less sure about, but we do have to figure that out. But I feel emboldened that you're on the case, and Mike Bell and Tyler and Margaret Duvall and the folks at both Meketa and Primark that are helping us with some of our micro-credentials. I do want to thank you for that. And you certainly believe as an organization and you as a professional and a person in why education matters. So great discussion, great guest, and appreciate the partnership and the observations here today, Steve.
Thank you so much, Bill. It was a joy. Always fun talking with you. And if I can ever be of help in the future, don't hesitate to reach out.
I may be out in San Diego before the spring here in Boston. So, Steve, thanks again.
Okay, you bet.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the CAIA Association and subscribe to the show at caia.org. That's CAIA.org. See you next time.